Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane,
to the channel, where we talk about the latest in finance and the stock market. Today we'll be discussing the latest developments in the markets and what it means for investors. Let's do a quick recap. The equity markets were higher on Thursday, with the Nasdaq leading the charge and rising over 3%. The technology sector was particularly strong, boosted by an impressive earnings report from tech giant Meta, formerly known as Facebook. Meanwhile, the Federal Reserve and the European Central Bank both raised interest rates this week, which is causing the market to price in a more gradual pace of rate hikes and potential rate cuts by the end of 2023. The Federal Reserve's tone at its latest meeting was interpreted as less hawkish than expected, as Fed Chair Jerome Powell stated that the disinflationary process has started for the first time. Although inflation in some sectors, such as housing and rental, has cooled down, non-housing services inflation remains elevated. Powell also noted that financial conditions have tightened since the Fed's rate hiking campaign began. In terms of earnings reports, about 46% of S&P 500 companies have reported for the fourth quarter, and the results have been mixed but better than expected. 70% of companies have reported positive earnings surprises, which is in line with long-term averages. The outlook for first and second quarter earnings in 2023, however, has weakened and is expected to be below the 5% growth seen at the end of September 2022. Today, we're going to be discussing the recent earnings reports from some of the biggest tech giants in the industry: Apple, Amazon, Alphabet, Facebook, and how are we going to play this? Let's start with Apple, the company that has been known as a safe haven for investment in the tech space. Unfortunately, their first quarter earnings report wasn't what investors were hoping for. Apple missed analyst expectations on profit for the first time in 7 years, with a 4% drop in shares on Thursday. This was due to strict COVID-19 lockdowns and related protests in China that disrupted iPhone production at their biggest supplier. The company also marked its largest quarterly revenue drop in nearly 7 years, posting $117.2 billion, which was lower than analysts' average estimate of $121.1 billion. CEO Tim Cook stated in a call with investors that iPhone revenue would have grown in the quarter if it wasn't for these supply issues, but production is back to pre-shutdown goals. Next up is Amazon, the tech and retail giant who is facing a reset after its pandemic boom. The company reported a net loss of $2.7 billion for 2022, compared to net income of $33.4 billion the year before. This included a pre-tax loss of $12.7 billion on their investment in electric vehicle maker Rivian. Although their most reliable division, Amazon Web Services, reported sales of $21.4 billion, which was an increase of 20% from a year earlier, it was still below analysts' estimates. Alphabet, the parent company of Google, also missed analysts' expectations. This was due to a pullback by advertisers that hit the search giant's revenue. Sales at Alphabet reached $63.1 billion for the quarter, which was slightly below the $63.2 billion projected. Last month, Alphabet cut 12,000 jobs, or 6% of their global workforce, and promised to create a leaner, more efficient company. However, they were then hit with a U.S. Department of Justice lawsuit accusing them of abusing their dominance of the digital advertising business. Finally, let's talk about Facebook's parent company, Meta. In stark contrast to the other tech giants, Meta delivered better than expected results and their shares surged as much as 26% on Thursday. This was thanks to CEO Mark Zuckerberg's vow to make the social media company leaner, which was welcomed by analysts who upgraded their recommendations on the stock. In conclusion, it was a mixed bag of results for the tech giants, with Apple and Amazon reporting disappointing results, while Alphabet just missed expectations. However, Meta bucked the trend and delivered better than expected results, with a significant boost in their stock price. It just goes to show that even the biggest and most valuable companies in the tech industry aren't immune to the challenges and uncertainties that come with a global pandemic and a slowing economy. Here is how I am playing these. We should see continuation on the downside, find a level of support, and we will stay there for the rest of the day, unless jobs report and PMI will have a big impact on the market. For a long-term play, bad earnings and stock drop make it attractive to step in and scoop some shares or even leaps. I think I will wait a bit longer to step in and sweep some sweet shares, at least until next Tuesday. What happens next Tuesday, you might ask? Find out in the next video. That's all for today, folks. I hope you found this information helpful and informative. As always, keep an eye on your investments and make informed decisions. Don't forget to like, comment and subscribe for more financial insights and analysis.